Our question is, explain the structure of Indian money market. So, firstly, I will tell you about money market. Money market is the center of dealings mainly in short-term monetary assets. Essence in accordingly, money market refers to the organization for the lending and borrowing of short-term funds through the use of such instruments as commercial bills of exchange, short-term government securities, bankers' acceptance, etc. Crowther के accordingly, money market is the collective name given to various firms and institutions that deal in the various grades of near money. Structure of Indian money market can be um, shown in the following chart. Number one, financial institutions. It is of financial institution of Indian money market are divisible into organized sector and unorganized sector. Organized sector of Indian money market is the that sector whose parts and activities are systematically coordinated by the monetary authority. It comprises of the following institutions: Reserve Bank of India. At the apex of Indian money market is the Reserve Bank of India. It is the central bank of the country. Commercial banks. The commercial banks dominate the organized sector. It includes public sector banks, State Bank of India plus its associate banks plus nationalized banks plus regional rural banks. Private sector banks, scheduled banks plus non-scheduled banks plus foreign banks. Cooperative banks. They Cooperative banks, they are the part of cooperative credit institutes that have a three-tier structure. At the top there are state cooperative banks. At the district level there are central cooperative banks. At the local level there are rural primary cooperative banks and urban cooperative banks. Structure of Indian money market. Financial institutions, organized and unorganized. Organized are Reserve Bank of India, public sector commercial banks, private sector commercial banks, cooperative banks. Further, public sector commercial banks are of three types: State Bank of India and its associate banks, nationalized banks, regional rural banks. Private sector commercial banks are scheduled banks. Scheduled banks are further of two types: non-scheduled and foreign banks. Financial instruments are of three types: call money market, bill market, and bank loans. Bill market is of two types: treasury bills and general bills. Unorganized sector is of four types: indigenous banks, money lenders, chit funds, and nidhis. Unorganized sector. The unorganized market is that market whose activities are not systematically coordinated by the monetary authority. It is largely made up of indigenous bankers, money lenders, chit funds, and nidhis, etc. Financial investment instruments. The second component of Indian money market are the financial instruments which provide short-term credit. These include bills, treasury bills, promissory notes, hundis, certificates of deposits, and commercial papers. Organization of Indian money market. Call money market. The call money market deals with loans of very short duration. It mainly deals with one-day loans which may or may not be renewed the next day. The participants in call money market are mostly banks, therefore it is called interbank call money market. Bankers acceptance market. By the acceptance market we mean the market for bankers acceptance which arise out of trade transaction both domestic and foreign. The market occupies an important place in European countries. There are such specialized firms in foreign countries who accept these bills, the moment any bill accepted by such firms can easily be sold or discounted in the market. But now the importance of these markets is declining because the central bank controls over commercial banks is increasing. Collateral loan market. In this market, the credit is available only when collateral securities is given. This security can be of any form such as pledge, mortgage, etc. The market for loans by collateral security is called the collateral loan market. Treasury bill market. Treasury bill market is that market which deals in treasury bills. Treasury bills are issued by the central government for short period loans. These bills are sold by the Reserve Bank on behalf of the government. These bills are purchased by Reserve Bank, commercial banks, non-banking financial intermediaries, LIC, UTI, GIC. Treasury bills are highly liquid because Reserve Bank of India is always willing to purchase or discount them. Commercial bill market. The commercial bill market is the market that deals in bills. Commercial bills are those bills which are issued by businessmen or firms in exchange of the goods purchased or sold. The buyers using promise notes promises to pay the seller a specified amount at a particular date. On the other hand, the sellers issue commercial bills directly to the buyers to pay a specified amount at a particular date for the goods received. The buyer shows his acceptance by countersigning the bill. These are generally of 3 months duration. They are like post-dated checks drawn by sellers of goods on the buyers of goods for value received. The bill holder can get it discounted in the bill market if he wants the amount of the bill before maturity. The bill market is not very developed in India. The Reserve Bank of India has attempted to develop bill market in this country. It has introduced two bill market schemes, one in January 1952 and the other in November 1970. These schemes were meant to increase the availability of rediscounting facilities with the Reserve Bank. However, due to some inherent weaknesses, these schemes failed to promote a sound bill market in India.